this is the new sort of VIX monitor that I have created. It's pretty similar to the one we had before, but obviously I've plugged myself into the new data feed. So anyway, this allows me to see what the term structure does over a certain number of days, whatever. And then I always track the front two contracts to see what the roll down is. So we've got a positive roll down now. Obviously, we had a negative roll down into the election period because we were in backwardation, but we're in a more normal contango. That roll down generally can be anywhere between sort of 5 and 10%, depending on the steepness of the curve and how things are. VVIX obviously is our kind of implied vol of VIX options. So on the plot, I've got the VVIX, the VIX, and the front month contract here. So you can see how they move. Often the VVIX acts as a bit of a lead indicator for the VIX. So we do often see when VVIX catches a bid and VIX hasn't moved, often the VIX kind of then does move later to catch up. So there's almost like a bit of a lead there on VVIX. And then the VIX beta. So why do I track VIX beta? So this is something we cover in the advanced course that I do, right? And the idea is that the big use of VIX options is for hedging purposes. Okay. So just like buying puts on indices like S&P or whatever, you can buy calls on the VIX to achieve the same thing. Okay. And there will be times when owning VIX calls is a better trade than owning S&P puts. And those times are like where the VIX has got to somewhat of a flawed level, call it 12, 13, whatever it is. And the S&P is rallying and it's at the highs, right? And then you can have a situation where if you just buy puts on S&P and we rally another 200 points, those puts are going out the money. They aren't going to do you any favors. They're going to lose their premium, right? But if you bought calls on the VIX and we rally 200 points, the VIX can just completely float. And it might even, if you're lucky, go higher, right? Which means your calls, haven't got more out of the money and they might even have made some money, right? So you get this situation where the VIX fails to fall on a rally on the S&P. And that's when the VIX beta drops to near zero, basically, right? Okay. So what we're doing is we're tracking that VIX beta to see if it's getting lower or higher and how the VIX is behaving for moves in the S&P. And when we identify a period where we're seeing that beta compress, then we're getting more confident about owning VIX as an alternative to being short the S&P, basically via optionality, right? So that's the real reason for tracking the VIX beta, is to get that sense. So the VIX beta right now obviously is still at 4, which is kind of a long run average, right? The long run average is somewhere in that ballpark. And, the VIX beta was a lot higher. It was at like -7 because we had that massive explosive move in August when the VIX ripped and the market dropped. So we're in kind of no man's land in VIX beta right now in terms of what it's telling us. I do suspect if we do continue to rally through 6,100 on S&P, the VIX beta is going to continue to tank and it's going to fail to drop to the extent that it should. But that's more my suspicion just through experience. But then so the VIX is telling us the VIX beta is telling us the sensitivity of the VIX of the VIX futures, by the way, right? There's not a lot of point in us measuring the VIX beta of the VIX spot because we can't trade that anyway, right? So we track the VIX beta of VIX front month futures to the S&P. And then if you think about it, what does the VIX itself represent? The VIX itself represents the volatility of the S&P, okay? So if we know the volatility of the S&P and we know the VIX beta to the S&P, in theory, multiplying the volatility of the S&P, which is the VIX, by the VIX beta should give us a pretty good idea of how the VIX itself will move, because the VIX is going to be a function of what the S&P does and its beta to the S&P, right? So that's why I compare the VVIX divided by the VVIX-VIX ratio of 6.5. I compare that to the VIX beta, right? Because those two things shouldn't be massively out of whack. Now, there probably should be a slight premium on the VIX, on the VVIX over VIX, right? Because of that kind of extra optionality, right? That extra risk premium that they will embed in VIX options, right? But it's just good to get a handle on that, because you can then say to yourself, well, yeah, if VIX beta's 4 and a bit right now, but VVIX over VIX ratio is 6.5, then I'm certainly not getting cheap optionality when I buy VIX options, right? It's relatively expensive compared to how VIX is actually moving right now. And if that VIX beta was 2.5, 3, and the VVIX VIX ratio was still at 6.5, again, even more expensive. So it's just giving us an indicator of how expensive VIX optionality is, right? And yeah, and that might be in itself telling you something, right? If VIX optionality is super expensive, then it means people are really, really feeling the need to hedge, right? They really do want to pay up for that, even if the market doesn't look like it's doing much, or the market's at the highs or whatever.